Oh man, it's one of our favorite days. Well, when the market goes up afterwards, unless of course you're a bear. The J. Powell Federal Reserve FOMC Federal Open Market Committee meeting. So today we will be covering exactly what Jerome Powell says is his presser. We'll add commentary, obviously. We are going to play Fed Bingo. In 5 minutes, we will be getting the Fed's rate decision. Obviously, we expect the rates presently to be held stable. What we are most interested in, though, are going to be the revisions in how the Federal Reserve conveys that they are setting up for cuts. We're looking for the removal of the phrase additional policy firming. So within the next few minutes, I want you to pay attention when this document comes out. We're looking for the removal of the phrase additional policy firming, and that'll probably be replaced by some form of phrase like adjustments to the target rate. I don't think they'll directly say anything about rate cuts at this point. We'll keep that optionality open for the Federal Reserve, and yeah, we'll see what teasers they give for either a March 20th rate cut or an April or a May 1st rate cut. So we'll see. Those are about 5 weeks apart. Right now, the betting market before the meeting gives us about a 95.9% chance that we're getting no rate change right now. There is a 4% chance right now that we are going to get a rate cut today. Nobody thinks that. That would somewhat signal this concern that the Federal Reserve is worried about something, which maybe they ought to be worried about something. Like, how about the New York Community Bank? Holy crap. If you have not yet seen my video on the New York Community Bank, I highly encourage you go watch it, because it's basically like a bank failure occurring in our face right now. So go watch that video either after this or whatever you want to do, okay? So these regional bank headlines are going to be a big deal. So we'll watch this. Now, the odds of a rate cut in March are now sitting at 55.5%. That's a jump. Actually, no, let me add this together. I'm sorry, 57.8%. Let's add that correctly. That's wild. So we've gone from like a 38% chance of a cut to 57%. We got some movement here. This is also leading to movement in the bond market. Bond market 10-year down 9.2 bips right now. 2-year down 11.9. That's actually going to put us at a steepening 10-2 curve. A lot of bears waiting for that inflection point. The inflection point's not too far away. We're negative 28 basis points inverted right now. 5-year break-even inflation. What does the market think inflation's going to do over the next 5 years? Next 5 years, we're looking at 2.25 for the 5-year break-even. Comes after ECI this morning, Employment Cost Index, which came in at 0.9. Annualized, that works out to 3.6%. 5-year forward, which would not be the next 5 years, but the 5 years thereafter, sitting at 2.31. Okay, we are now within 2 minutes of the statement being released. What we are going to do is, I'm going to look over here this way, and I'm just going to read off the headlines from the actual document. Then we will go through the actual document. After we go through the actual document, we are going to make Fed Bingo. So I want you to start thinking about, is the Fed going to talk about the banking crisis? Are they going to talk about the Bank Term Funding Program? Where and what is the Federal Reserve going to do? This is a big deal. Let's see here. Okay, so at the same time, I'll also work on making sure we've got some of these updates going over to eHack as we're actually receiving the updates. So I'll be kind of doing that live, which I kind of enjoy doing anyway. It's perfect. So then we are, let's see here. We are obviously also going to watch, we've got CNBC ready to go. We've got them right here. We've got the Qs up so we can see how the Qs reacts. The Qs right now, keep in mind, they are down, but they are also down because of the Google and AMD earnings, which weren't actually that bad. They just weren't, I think, as juicy as people had hoped. So that's okay. So we've got a lot of things going. Got the iPad ready to go. We got our angles. We got everything, boys and girls. So this should be pretty fun. All right, so let's get into it. Again, I'm waiting for the headlines. The headlines are going to be out within the next 5 seconds or so, and then I'm going to start reading off the headlines. Ready? Okay, and we have, does not expect it will be appropriate to reduce rates until there is greater confidence that inflation will go down. Okay, so does not expect to reduce rates yet. Obviously, the rate, as expected, stays stable. They did not change the rate. Fed judges risk to achieving employment and inflation goals are moving into better balance. Leaves key overnight policy rate unchanged. It does not expect it will be appropriate to reduce rates until greater confidence towards 2%. Outlook remains uncertain, highly attentive to inflation risks. Recent data suggests economic activity has been expanding at a solid pace. Job gains have moderated but strong. Unemployment remains low. Inflation has eased but remains elevated. Fed says economic outlook uncertain. Activity has been expanding. That's the same thing. Jobs have moderated but remain strong. Unemployment remains low. Reaffirmed statement on long-run goals and monetary policy. In favor of the policy was unanimously reaffirmed statement on longer-run goals. We have staff with access to most sensitive FOMC information may need to submit brokerage or other transaction statements to verify disclosure accuracy. That's fine. Will tighten restrictions on Fed regarding confidential information. This is nonsense. Additional information. Increases the number of staff covered by the most stringent restrictions on investments. So more people at the Fed will fall under this disclosure rule. Okay, whatever. So it's an update on the disclosure rules. Rates stay the same. And then, again, the big line here, does not expect it will be appropriate to reduce rates until there is greater confidence inflation is moving sustainably towards 2%. The Q's falling slightly on this, not a lot. This is not, in my opinion, a big deal because, again, they don't want to signal that it's time to cut now. We knew that. We expected that. Instead, we expect them to leave their optionality open. Do we go for March 20th or do we go for May 1st? That's what we're expecting. We are looking at a higher likelihood right now that we're going to get them in March, by March 20th because of the banking crisis. That might be rejuvenating, but TBD. You'll get 2 inflation and jobs reports between now and the March 20th meeting, and you'll get 3 between now and the May 1st meeting for jobs and inflation reports. Okay, here it is. Job gains have moderated. We saw this. Okay, this is actually good that they're paying attention to this. Job gains have moderated because they actually are. Like, it's a big deal that job gains are moderating. And it's going to be worse. It potentially causes a labor recession. So it's not great. So better balance. Okay, let's see. Inflation has eased over the past year but remains elevated. The committee seeks to achieve maximum employment inflation rate of 2% over longer run. We already know that. Okay, the committee judges the risk to achieving its employment inflation goals or moving into better balance. This is really the first time I think we've seen this on the FOMC statement. Outlook is uncertain. Okay, so they got, where's the adjustment? Here it is. In considering any adjustments. Okay, remember what they had beforehand. Before, it was determining the extent of additional policy firming. That's gone. And now we have in considering other adjustments. Okay, actually, let me see if I could just get the side-by-side view here. I can. We have different voters also, so you're going to see a little bit on different people voting. That's normal because this is the first FOMC meeting where you're in the new calendar year. So you're going to have some names get replaced. That's normal. And okay, here is the flip. Let's look at the strike sheet. Recent indicators suggest growth has slowed. That was removed. Growth of economic activity has slowed. That's been removed and been replaced with been expanding at a solid pace. Job gains have moderated since early last year, but remain strong. U.S. banking system is sound and resilient. Oh, they took that out. Whoa. That's very interesting. No way. Do they end up re-saying this somewhere? That's wild. Look at that. They removed the U.S. banking system is sound and resilient. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity. They removed that as well. Highly attentive to inflation risk. Better balance. Okay, here's the additional policy firming section, which was replaced with, in considering any adjustments to the target rate for the Fed funds rate, the committee will carefully assess incoming data, balance of risk. The committee does not expect it will be appropriate to reduce. This is the line here. This is how they're defending themselves now. Does not expect it will be appropriate to reduce the target range until it has greater confidence. Yeah, but that could come in the next 2 CPI reports. So that's okay. This is not a big deal. But this is what we expected them to do. Near-term bearish, longer-term bullish. This is fine. Committee will continue reducing its holdings of treasuries as described. And then they get into in assessing the appropriate stance of monetary policy, blah, blah, blah. What, why? Where? They completely got rid of the banking comment. That's wild to me. That's very, very, very interesting to me. So the removal of this banking thing, I want to see if anybody else is catching on this.
The dollar index getting closer to unchanged. The way I read this is I'm totally in agreement with Bob Pisani. It's a giant Rorschach. Pretty much, if you look at all the data points, whether it was ECI, ADP, regional Fed surveys like Chicago, Philly, there's definitely weakness coming into the economy. You could still argue the labor market's doing better. We did see jolts. We did see consumer confidence. So there's some cross signals going on. But maybe some of the best signals are, harken back to 2018, 2019, when the newspapers were all upset with the president. Political meddling and rate setting, heresy. But yet, look at what's been going on the last couple days. On the 30th, Tuesday, Senator Sherrod Brown writes a letter to Chairman Powell saying you really need to ease. Over the weekend on Sunday, you had Elizabeth Warren, Senator Hickenlooper, Jackie Rosen, Sheldon Whitehouse, all write letters, a letter, and all sign them, all four. You need to lower rates. It seems though the senators are a bit nervous. I would think, based on the verbiage of most of the Fed speak I see, they're going to keep talking tough, but they're going to give the market more than 3 rate cuts this year. I'm not sure if it's going to match the market's ultimate aggressiveness.
Yeah, all right, we've heard enough of this. Okay, so we need to really think about this. This is very interesting. I want to see what some of the other suits are saying. The removal of this sound and resilient part. Why did they remove that? Every line they leave in here is a big deal. So I want to see what the suits are paying attention to. So the suits are saying, remember that it isn't over until the Fed chair speaks. Duh. The Fed removing reference to further hikes, but they emphasize that cuts aren't imminent. That's just a way of balancing, right? It's a way of balancing the statement to say, hey, hey, we don't urgently need to cut in March. Maybe it's May, right? Maybe May. Who knows? That's basically what they're trying to say with that, okay? Remember, 2 CPI and jobs reports between now, March 20th, 3 between now and May 1st. Okay, this suggests a neutral to dovish stance. Stocks, let's see, some knee-jerk disappointment. Yeah, I guess a little bit here in the stock market. You've got sort of a little adjustment down, maybe about 30 bips to the downside there. Tesla as well. If we go to the minute chart on BTC, a little bit of a down candle as well. And no support over here, obviously, for the New York Community Bank. So keep watching these here. But anyway, this is a very interesting removal. Let's see what else they say. The language about the policy, let's see here. The language about... okay, what do we have here? Firming policy, that's fine. Nobody's talking about where's the bank part. How is nobody catching this bank part? Nope. Here's the full better balance. They're also saying the economy is uncertain. They've literally said that same thing forever. The committee does not expect it will be appropriate to reduce until 2%. That's fine. Note the word adjustments. It's not easing specifically, but it is a cutting bias. That's fine. Firming in policy has been removed to a neutral word. That's fine. Where's the bank talk? No suit is talking about the bank. What is this?
Stocks, but not significantly so. So maybe there was just an incremental amount of development with regard to expectations.
Yeah, this is stupid. How could you say I see you here in the comments, Mark. How are the banks less relevant? You must not have seen the New York bank video this morning. Have you seen 38% on New York Community Bank? RIP. That's a big deal. This is very, very strange. I'm trying to understand how to piece this together, but what we need to do is create Fed bingo now for what's going on. But I think Jerome Powell is going to pick up on the fact that they didn't mention anything on the banks, and it's a problem. So let's make Fed bingo and try to get to the bottom of what we think they're going to say, and then obviously we'll compare. So go ahead, do me a favor, and start throwing out some suggestions for what we're going to put in Fed bingo. Let's quickly also look at yields. Bond yields down 7.1% on the 10. This is a slightly hawkish adjustment the way markets are reacting. It's not a very, it's not like a skyrocket or a crash or anything. Honestly, I think that's what the Fed wanted. Okay, one sec. One, we got to make our bingo card. 2, 3, yeah, 4 lines to make a bingo. I'm so bad at getting Fed bingo, but I get so close all the time. I'm going to start taking like what bingo boards actually do into heart, and I'm going to stop forcing myself to get the middle bingo. And well, you know what? We'll make it an easy one in the middle because I still think it's fun. Okay? J. Powell on time. The guy's like a clock. Okay, we'll give us an easy one. Okay, we need to hear banking. Like, okay, I'm going to put on the edge here because they got rid of it. Sound and resilient. I think Jay Powell's going to realize that people are like, wait, why didn't you say anything about the banks? And then I think he's going to have to like quickly comment that, don't worry. No, we didn't mean to take that out. We forgot. We accidentally hit the backspace button too many times. This is like on a day, literally a bank is essentially collapsing. You remove the phrase sound and resilient. That's sus. All right, let's see here. Okay. Sticky inflation, geopolitical conflicts. That's pretty good. Okay, somebody, I see your comment here. What do we have here? Okay, it's fine. All right, election, sure call it. No, we're not going to do sure call it. Soft landing. Are we going to get soft landing? That's interesting. Okay, let's consider that. So, okay. Let's put soft landing in the corner over here. Soft landing. So we'll just have reference of soft landing. How about, there's going to be a question on cuts, right? So let's write this down. Jerome Powell, I'm going to say Jerome Powell punts question on March versus May cut. So some kind of punt on this. How about, let's go with financial conditions. Okay, I think that's a pretty easy one. I mean, we'll probably hear about that. We'll talk about easing financial conditions. How about, are we going to get anything on housing here or jobs, labor for sure? We need to have labor easing. We're probably going to see something on services becoming less sticky, maybe. Services less sticky and then we could talk about core PCE at or below target, right? That would be good. Core PCE below these levels, that would be very good. Okay, let's see. I want to see what else y'all have here in the comments. By the way, I'm watching the NASDAQ recover right now. So that's good. One sec. Okay, there we go. There we go. Okay, good. Looking at your comments here. War. I mean, certainly geopolitics is a good one. Bank term, yes. Bank term funding program. Absolutely. Bank term funding program. We want to talk about, are they going to extend it? What happens if a bank has a problem? Let's get New York Community Bank in here. I'm going to put that on the edge. Let's get Red Sea. I'm going to throw that on the edge. Let's get, we need geopolitics and Iran in here. How about a slowing in Germany? Slowing in Germany. Oh, okay. All right, this is just going to be a fun one. I got to throw a fun one right here, okay? Nick T sits next to the blonde from the New York Times. I have to. I don't think he'll say the word recession. He doesn't do the iPad anymore. Yellen's not going to step down. I don't know. I want to get bingo. I mean, I don't want an easy bingo, but Deflation. Ooh, QT talk. Okay. Slowing QT. That's a good idea. Deflation. The risk of deflation. You know what? I'll write that one down. Deflation. Election. He's if he says anything about the election, it's just going to be that they're something to the effect of like, we don't let politics affect us, right? We don't let, which we know is probably BS, but whatever. At least they can say that. Housing affordability. If another reporter mentions Taylor Swift, buy Kevin's ETF. Oh, that's interesting. Buy the courses on building your wealth. Coupon code expiring today, which is true, by the way. We've got some more videos coming out too, which is fun. Stocks all-time high. Yeah, we never get them to talk about fate, but I'm gonna write that one down here, so that we're gonna put like runner-ups. Fate, housing. I mean, we could say something about rents. How about declining rents in multifamily? I like that. Declining rents, and so it's specific, right? Multifamily. We could do like loans coming due, stuff like that. Deflation we have. Glasses actually fall. Dual mandate. Yeah, the balance around the labor easing. And so like, I like that idea. Like something where we're basically like, look, dual mandate balance, but then also something like, attentive to layoffs or too much easing here, right? In labor. Yeah, that's good. Yeah, declining rents in SF. Yes, it's crazy, man. Rents right now are nuts. Fall. GDI. Ooh, generative AI. COVID. Hire no longer. Shut the effing door. China. Let me quickly see. Let's see if we can get some inspiration from what some of the other things are that we're expecting. We'll also watch the cues here. So speaking of two elements in the Fed's mandate, remember that the minutes of the December meeting showed that a few policymakers were worried about the possibility of focusing on inflation causing damage to the jobs market. That's true. Fed's trying to normalize rates. Yeah, well, they're going to have to come down. Note the new language. At this point, the shift in stance we've been discussing until now is getting inflation mandate back to target. That's fine. The better balance part is interesting. We'll have to see if Powell gives us any insight on whether the FOMC will discuss balance sheet changes. That's true. New York Community Bank Corp news today. Clarida says it does not seem systemic for now. Unless I've there we go. The suits are picking it up. Unless I've missed it, there's no reference to the banking system. Yup. Okay. Very interesting. I guess Clarida went right on after this. That's crazy. They instantly had Clarida go on Bloomberg to shut up the banking crisis talk. That's wild. Clarida. So after the notes came out, Clarida quickly went on Bloomberg to clarify New York Community Bank is not systemic. New York Community Bank, not systemic. That's kind of wild. I want to see if I can get a shot of that. I don't know. No, probably not. Wow. Okay, well, that's okay. We have the notes here of what was said. It was just to clarify. Well, actually, let me just type in. I can go just look up his name, and then we'll get everything that he said. Clarida news. Okay, I got it. Okay. That's not going to be easy for me to play that. That's okay. Oh, yeah, no. Okay, that's a 20-minute segment. We don't need that. Just give me the bottom line here, folks. Clarida. Oh, Disney lawsuit against Ron DeSantis dismissed by federal judge. I like how they tried to bury that in the Fed headlines. Clarida warns Fed rate hikes still in play on strong economy. That's old news. No, oh, sorry. No, that's super old. Okay, never mind. I can't get the transcript right now, but screw it. Let's go. What would another way be? Okay, what do we have? We have 10 minutes to go until we actually have the, what's it called? Fed special, yeah. 10 minutes to go until J. Powell comes out. Let's see, do they have a... That's Robert Tipp. That's not Clarida. Let's see where they had him. Oh, there he is. Rich Clarida. He came on... No way. He was there within 3 minutes of releasing the statement to talk about the bank. Okay. We're going to do it. Hold on. It's going to look funny. But anything to understand what was just said. Okay, here we go. Okay. He's just yapping. Dallas Fed trim mean. Mid-twos on inflation. Dallas. Hold on. Why is the Fed not prepared to embrace the rate cut conversation? He says, I actually agree. I'm looking at the data. I thought March would be too soon. And remember, he's not at the Fed anymore. Okay. Okay. Yeah, okay, all right. So that's really interesting. So we know he's not there anymore, but he's a buddy of Jay Powell's. And so I think they sent him on Bloomberg to clarify this. I want to see the banking comment, though. Yeah, here it is. They're just now asking about it. I'm going to feed this to you once we'll just say it. Given what I know right now, the reality is, we have a bunch of regional banks, blah, blah, blah. Fed did what they needed to do. Right now, this doesn't appear to be systemic. That's Clarida. But it's on their radar. Yeah, okay, all right. That's not a big deal. I mean, it's not a big deal for a few parts, mostly because, I mean, he's not at the Fed anymore. That's part one. Part two is, you know, I don't know. The way they phrased that question, I don't know that he really came in prepared knowing about New York Community Bank. He may honestly not even know what's going on. I mean, I don't know. But, yeah, he's over at, like, PIMCO Asset Managers now or whatever. It's funny how you go from working at the Fed to jumping over to basically collecting your pay as a fund manager. Got to get those bips. But anyway, yeah, I think this is pretty wild. Let's see what they're saying over here.
Soon, inflation could re-flare up when perhaps it's not completely under control.
I think what's on their minds at the moment is this very strong top line growth in the economy. And if they were to cut too soon, they might very well stimulate to the point of a resurgence in inflation. So they certainly don't want to risk that. If the growth numbers were closer to trend, more around 2% or even a little bit lower, it might be a different story, but they're running the risk of adding fuel to a fire that could create a reversal of the inflation picture.
See, yeah, I so disagree with that. I mean, I know you as viewers already know that, and I know a lot of you also disagree with me. I don't think growth creates inflation. We didn't have, I mean, we had growth since '82, and we had the opposite of inflation. So, but anyway, but I do think money printing causes inflation. But that just drives us out of deflation. It's crazy. But let's write that down. Let's finish our bingo card. So how about growth leading, growth to the extent growth causes inflation. Something like we don't know, right? We don't, like, I would expect Powell to say something like that. What else would Powell say today? So we got banking. Banking's gonna be a big deal. Like everybody's gonna ask about banking today. Premature rate cuts. That would be interesting. We don't want to cut prematurely. Okay, don't want to cut prematurely. Oh, and then of course we need like doing nothing. We need J. Powell to start planting the seeds of cutting, right? Plant seeds of cutting by saying doing nothing increases tightness, right? Something like this. So plant seeds of cutting by saying doing nothing increases tightness, or somehow explaining that, right? So, or explaining that. Okay, got it. Then we have 3 more to do. Fate. I mean, I could throw fate on here if I really need it. I really don't think they're ready to pull that cat out of the bag yet. I think they're kind of holding that one. Price stability, election interference. That's not going to happen. Yield curve, systemic risk, price stability. I mean, we might throw, Evergrande, nah, probably not too big of a deal. How about, let's see, some kind of, like, how about manufacturing? That's one, manufacturing. Manufacturing deemed to be in a recession. It's also related to slowing in Germany. And then we'll throw in, you know what? We'll throw in China. Why not? And then let's throw in, we got geopolitics, credit defaults. We're on the right path. Ooh, that's a good time. Mass layoffs. I don't think he's going to use those hard of words. But let me make sure I have enough. Labor easing over here. Increased layoffs. And, but still openings. So, you know, some kind of reference to GDP, probably, honestly. GDP above trend. Oh, yeah. That's what we should do for the last one. GDP above trend, but below potential, or some variation. Those are key words he's used before, where he kind of, it's like there's trend and then there's potential. And he just wants GDP to be below potential, not necessarily below trend, which is a funny, like, sort of like redefining of this. Okay. Let's see what else we have here. While the markets got worked up over the news that a New York Community Bank missed their earnings estimates, the complete removal of the statement around the tightening of financial statements shows the Fed is not concerned. Yeah, or they forgot. Yeah, this is interesting too. They could have easily said, hey, we're just going to look at future data, but instead preconditioning cuts. Did they really precondition? Let me see here. In considering any adjustments, we do not expect it would be appropriate to reduce the target range until the Fed, yeah, I guess that would be a precondition. Once they have greater confidence that inflation is moving sustainably. It already is, but we knew they weren't going to cut today. Okay. We can always print, that's true, but you don't want to cause that unnecessary hardship. Yeah, the blonde girl from the New York Times is going to ask a super question. She actually is very smart. She's very good. That her name's it's like Jenna Smilyak or something like that. Her and Nick T usually ask very good questions. Some people, though, just ask these, like, horrible, moronic questions, and they just drive me nuts. So, there's the door. Okay, one more minute now. When printer? Printer's back there. Jenna Smilyak. Smilek? Whatever. Yeah, let's check if the March rate cut estimate changed. That's a good idea. Good idea. Okay, here we go. Fed rate cuts. 56% chance. Yep. So we're going to write that down on ehack.com really quick. And we're just going to say pre-speech, 56% chance of cut. March 2024. Let's listen.
So if I cut you off, it's only for a good reason. A final question-ish, depending on when Jay Powell comes in. The market reaction, you mentioned pullback. How significant could it really be, given that financial conditions are as relatively easy as they've been for a while now?
Yeah, unless something changes on that front, the credit front, or if rates really take flight from here or something, I don't think that the stock market is set up for something nasty. Therefore, usual 3 to 5% random pullbacks.
I'm going to be writing notes, by the way, at ehack.com while he's going. So that way I don't have to be like super interruptive, which I usually don't think I'm super interruptive, but it'll help. All right, he's on time. He's on time. That's the first bingo piece.
Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news.
Yes.
But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments.
Monetary.
Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December.
Do the 6.
Excluding the volatile food and energy categories, core
6.
PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Here we go. Peak rate.
Sheena Smiley from the New York Times. Thanks
There
for
she is.
taking our questions. Obviously, in
They're
the
together.
statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. If you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
Okay. That's
And
very
sorry,
bullish.
If I could just follow up very quickly,
Yes.
when you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I
Good
think
question.
I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition. But we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
This is all about just reiterating that 6-month trend, that the 6-month trend is already good enough.
Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there
gone.
were risks of inflation expectations becoming unanchored.
Gone.
This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now
Nice.
that you have avoided those two risks?
6 weeks is March.
So,
Smart.
As you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2% so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all because, for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around to see, the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Hi, thanks, Chair Powell. I'd like you to...
He didn't fall for the 6-week thing.
In the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Notice quickly on screen here how he's dodging the 6-month talk. He's always come up previously and talked about 6 and 3 months, not today.
To the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did, talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering, moving the federal funds rate down.
Today.
I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents. So, of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming. And we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
Here we go.
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Okay.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
Yeah.
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
I think I just heard this cycle is different.
According to the economy, would you say relative to the neutral rate?
So I think it's of course you know that it's not something you can identify with any precision. But a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, there are many, many ways to calculate that neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is when that peters out, I think the restriction will show up probably more sharply.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market by many measures is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and you know, I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, you know, we were kind of thinking, well, maybe we won't get it back. And then in 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance, and that's what we want to see. And you know, one great way to look at that is what's happening with wage increases, and you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Hi, Chris Rugaber at Associated Press. Thank you.
Bank talk.
I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Okay. MeetKevin.com.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%. And
Yes.
there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
Good question.
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Okay, that's bullish. Don't want inflation to go below.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
Ooh.
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that.
Killed March.
That's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Wow, he went from punting May or March to just saying, yeah, probably not March. You're going to totally unprice that now, so you're going to see some red after that.
Growth. You've mentioned multiple times about the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? Activity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity
That's
right
one
now?
way to look at it, yeah.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So,
And
when are they going to talk banking crisis?
a letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable.
my response is what I started with, which is that
Not my job.
the job Congress has given us is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
No Fed. Come on, banking. Somebody's got to ask banking.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March.
Wow.
So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Yeah, basically you can still cut rates while conducting QT. Come on, banks,
Simon
man.
Rabinovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Good question.
I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction. And we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
6:15 now. 6:15 on the reverse repo facility. Billion.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a third term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Punt on politics. I'll take it. Come on. How is
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months.
He didn't mention
and you
that.
guys are actually expecting core inflation higher
He
this
didn't say
year
that.
at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path.
Yep, that's why I didn't
down
mention
to
the 6.
2% or toward 2%.
That's exactly why I didn't say the 6, because it doesn't align with the weight. the 6-month aligns with cut now.
Hi,
That's
Chair
why he
Powell,
punted
Daniel
that.
Davis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case, and we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But you're right. It is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Okay. Thanks. Come on.
Thank you for taking our questions. Brian Menace, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at companies, individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the Outlook go around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes.
Well,
I mean,
read
if
the
you
beige
look
book.
back, the last, not this beige book, but the one before, it was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing, not in every district and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
What? Dude, no banking question? You've got to be freaking kidding me. Were they instructed not to ask anything about banking? This is scary. What the hell? Oh, okay, I'll give a summary, but there's some bullshit. That's weird. It almost makes me feel like they censored them or something. I don't know. That's very weird that you could remove the banking statement and you could have a bank collapse 37% today and not bring it up at the meeting. So either the reporters are idiots or the Fed told them not to ask. Wow. That's sus. Okay. All right. Whatever. Let's do the summary. Keep in mind, meetkevin.com, expiring coupon code. You're really missing out if you're not in the course member live streams. Let me just give you the quick pitch, okay? Course member live streams every day. Real estate analysis, Q&A, stock analysis, fundamental analysis. I do it for you every single day. I love doing it. Every day the market's open. Hope you're there. You get lifetime access. Just join any of the courses. They all get access to them. You can also bundle up if you email us at staff@meetkevin.com. Okay, great. So ready? Let's go do the summary now. Here we go. I'm not sure whether to be excited or shocked and really concerned after this Fed meeting. No, not because of the economy, but because of what the Fed did not say. Now, we'll talk about what they did not say in just a moment, which is absolutely ridiculous. But more importantly, right now, we'll focus on what happened today. Okay, so let's go through it, just like we've got it at ehack.com. It's all broken out, and I will, of course, give you some added context. Fed rates stay unchanged. Really weird. Two things they did here, though. They removed that the banking system is sound and resilient. They removed that. They removed comments about tighter financial conditions because financial conditions have loosened. And they removed commentary about the potential for additional monetary policy firming. They removed that and changed that turned that into in considering any adjustments to the target range for the Fed funds rate. The committee will continue to assess incoming data. Okay, fantastic. So what's interesting here is Jerome Powell said a few things that were quite bullish at the beginning of the meeting. Beginning of the meeting starts off bullish. We're well into restrictive territory. We've been below trend on job gains in the prior few months compared to the months before that. That was interesting to me because we've obviously talked about the idea of loosening labor markets and the potential that there's more of a balance now towards making sure we're not causing unnecessary employment. Jerome Powell, it's almost like he wanted to cut already. And so he's sending these little signals, but he's not allowed to because they're trying to use the March meeting as their signaling tool. Think about this for a moment, okay? We'll draw this out really quick, but this is what I think they're doing. They're saying, here you go. We're going to go into the January meeting and we're going to punt in January. Then we're going to go into the March meeting, and what we're going to do is we're going to give an updated summary of projections. So we're going to punt January, which was expected. We're going to punt March, but we're going to give the market maybe a dovish summary of economic projections, right? So you take the two CPI and the two job reports. You take those, and if you need to cut, you can, but you probably just give a dovish SEP, summary of economic projections. Then he answered the question very clearly, hey, if interest rates stay the way they are, or rather inflation stays the way it has been on the 6 month, which is 1.9%, then policy would be in a different place today. Absolutely. That is a quote of his. So if we stay on the trend we're on now, rates are way lower, okay? The question is, will we stay on the 6 month path? And in order for them to feel comfortable of that, we are going to punt January, give a summary of economic projections for March, and then May 1 is probably going to be the more likely cut time. Keep in mind, Jerome Powell said that March is not the base case. So March is not the base case for a rate cut. Made that very clear. Some of the other things he noted. Labor demand is exceeding the supply of workers. He did in his speech a few times dodge the 6-month PCE. I think the reason he dodged the 6-month PCE multiple times, which you could see on this chart, the 6-month PCE is right here, this like orange line, it's 1.9%. The 3-month is like 1.6%. So I think the reason Jerome Powell dodges the 6 and the 3-month is because he has his prescription from all the other people at the Fed, and they're like, look, man, you need to bias until May, okay? Whatever you need to say, bias until May. Every other frickin' meeting, Jay Powell comes up there, he's like, inflation on the 12-month is this, on the 6-month is this, on the 3 months it's this. This time, yeah, inflation on the 12-month is still elevated. And then goes dark. He knows this is happening. So somehow he's trying to buy time for the other members of the Fed, kicking this can down to May. And I think I figured it out. Now, what scares me, and this is the part that scares me, I too thought May was more likely until they decided they would end the bank term funding program. So I thought they're going to cut in May, it's not going to be March. Then they end the bank term funding program, and I'm like, ooh, ending the bank term funding program, you're going to end up having to cut in March. Then what happens today? New York Community Bank collapses 37%. If you haven't seen my video on it yet, it's a big deal. The frickin' stock's still down 37%. This is a massive bank. This is a bank that has over $80 billion in customer deposits, and it's down 37% on the day. They're losing more money quarter over quarter. They're taking more losses, and they don't have any more cash to pay out based on my reading. Okay, watch the video. I have a full video on the channel about it. The New York Community Bank, another big bank failure, is in the brewing. But this is what actually gets really scary, is Jerome Powell's basically like, what banking crisis? We're going to cut in May, not March. Not only that, not a single reporter, okay? Not a single frickin' reporter asked about the fact that from the statement they removed, quote, the banking system is sound and resilient. So they remove the banking system is sound and resilient. Then after removing the banking system is sound and resilient, what did I just tweet on Twitter, on X? I wrote, what the F? Not a single question on bank stability at today's Fed meeting after New York Community Bank / Flagstar plummets 37% and the Fed removes banking as sound and resilient from their statement. And I go, were the reporters instructed not to ask about banking, or were they blind? So they're either dumb and blind, or they were asked not to ask about banking, because this is a big deal. So maybe somebody woke up this morning like, I only have to do the Fed meeting today. I'm going to stop doing any kind of research. This is crazy. Absolutely nuts. Okay, anyway, going back to eHack. Oh, quickly, before I mention eHack, did you know that we have a coupon code expiring today? You could get the gold membership, the how to make more money with productivity and AI. How does Kevin get done so much? I give all my secrets in gold and the AI course. Stocks and psychology of money with buy-sell alerts, 0 to millionaire real estate investing, do-it-yourself property management, be a real estate agent like Kevin, or make videos like Kevin does on YouTube, whatever. All of them available. We do have a price increase happening tonight at midnight, so if you want to get in, make sure to check these out. You get lifetime access to the course member live streams, and when I add new lectures, you get those as well. Okay, so what else? Jerome Powell says, we thought we needed a softening economy. Now, this was bullish. He says, we thought we needed a softening economy, but we might not need a softening economy. And if we cut too late, we could end up hurting the economy too much. We have confidence in the economy, but we want greater confidence on inflation. He refused to give how much time that greater confidence would be. Does he need 7 months, 8 months, 10 months, 12 months of data? What does he need? Because he makes it clear that the 6-month path of inflation right now is good. And he made that clear later. He did mention the stock market started selling off after he mentioned this. He mentioned that, hey, we're not declaring victory. There's still some healing going on in labor and the supply chain side, and we have no idea exactly where things are going to go and if they're going to disrupt inflation. His worry is that if inflation anchors above 2% on the 12-month, then we have to hike more or stay higher for longer, right? Basically stay at 5.25 for longer. If inflation anchors below 2%, he says that would not be what we would want. And that would basically imply rate cuts. He's asked, is asked sort of about a summary of the economy, and he says, look, growth is still strong. Labor market indicates the labor market is strong. 2 years of labor market under 4%. That hasn't happened in 50 years. 6 months of good inflation data. This is a good situation. Let's be honest. This is good. But there is a chance we could see growth moderate, which hasn't happened yet. There is a chance we could see more pain in the labor market. And there's no guarantee that 12-month inflation will come down. So he's really looking at that 12-month to be convinced that it's down. Does that mean he's going to wait 6 months? Probably not, because he would go too far. Now, this is shocking. We did not end up getting bingo. We got a lot of items here, but we did not get bingo today. We did not hear anything about that banking sound and resilient. Otherwise, we would have had bingo. He said that every freaking meeting. That should have been an easy one. Didn't talk about New York Community Bank, Red Sea, geopolitics, manufacturing, China, Germany, nothing. The only thing we talked about at this meeting was basically PCE over and over and over again. We didn't even talk about the bank term funding program. Bro, this is like critical information. Are the banks going to owe all of their money back at the bank term funding program's expiration? Because if they owe it all back, we're going to have a banking crisis. Are they going to get loan extensions? Are they going to have some kind of repayment period? What if a bank needs help afterwards? But these are important questions. This is like the first time I'm like pulling my hair out going, bro, why are these questions like mental? These were so bad. I don't get it. So either the Fed is trying to like hide the banking issue and the bank term funding crisis, or they're blind to it. And I don't know which one's more scary. That it's being censored or people are blind to the problem. I don't know. But it's a problem. Regarding March, he made it clear that March is not the base case. We already touched on that. The reverse repo facility does not have to go to zero to start having cuts. And yes, you could have cuts with QT. Okay, great. So now the big question is, what happens? All right, here's what's going to happen. The market needs to unprice the rate cut for March. So we're going to go from a coin toss to like 20%, okay? That's why the market is red. The market's going to have to absorb that we have to wait 6 more weeks between March 20th and May 1st for the rate cut. Big deal. It's 25 basis points for 6 weeks. Suck it. It's not that big of a deal. But the market is going to have to eat that up. And so the market's going to have a little bit of an adjustment here. Once we finally unprice the March rate cut, then we need to pay attention to the banks, the rest of earnings, and then we just sit here and pray. And within the next probably 2 weeks, we're expecting to fundraise for househack.com. Again, if you want more updates on the real estate startup, there's a link down below. We have another update video that we posted about a week ago, and we'll have another one coming out soon. Go to ehack.com to see my full summary on pretty much the research that we do or some of the things that we're paying attention to. And then, of course, go to meetkevin.com to check out that coupon code for the courses on building your wealth and access to those course member live streams. In the meantime, huge thank you. Really appreciate all of you. It's it's been a ride the last few years, and the fact that somewhere around 22,000 of y'all chose at the same time to hang out with me is pretty remarkable. So as a thank you,
go yourself. Is that clear?
All right, I had to do it. Anyway, that's the Fed update. Thanks so much. I'm going to pay attention to the banks now. If you haven't watched the rest of the bank videos, go watch the bank videos. Join me in the Market Open live streams every day. The market is open, and we'll see you in the next one. Bye, everyone. Thanks again.